In a global financial landscape marked by persistent uncertainty, investors are increasingly turning toward traditional safe haven assets. While gold and silver have captured significant attention with their recent rallies, another, less conspicuous asset has demonstrated remarkable strength: the Swiss franc. The currency has surged to an 11-year high against the United States dollar, a movement that signals a deep-seated search for stability among global capital allocators. This appreciation is not an isolated event, but rather the culmination of prolonged economic and geopolitical pressures that are reshaping risk perceptions worldwide. As we witness this flight to safety, the behavior of the Swiss franc offers a unique lens through which to analyze the intricate dynamics of global finance, central bank policy, and the enduring appeal of economic and political stability. The Swiss franc's recent performance highlights its critical role as a premier safe haven currency within the international monetary system. Its ascent to an 11-year peak is a direct response to a confluence of global stressors, including escalating geopolitical tensions, unpredictable trade policies emanating from major economies, and growing concerns over the operational independence of key central banks like the United States Federal Reserve. For global investors and large financial institutions, the franc represents more than just a currency. It is a store of value underwritten by Switzerland's long history of political neutrality, robust legal framework, and prudent economic management. This deep-seated trust is why, even in an era of digital assets and complex financial instruments, the Swiss franc continues to attract significant capital flows whenever the global system shows signs of fracture. The currency's persistence as a financial refuge makes understanding the forces driving its value, and the policy dilemmas it creates essential for navigating the current economic environment. At the core of the Swiss franc's recent strength is its function as a systemic hedge against global instability. Since the beginning of 2026, the franc has appreciated by 3.5% against the United States dollar. It's building upon a substantial 12.7% gain recorded throughout 2025. This sustained upward trajectory, it's culminating in the exchange rate reaching its highest point in over a decade on January 27th, is a clear market signal. Investors are not merely chasing short-term yields. They are strategically repositioning their portfolios to mitigate risks that are becoming increasingly structural in nature. The primary drivers behind this capital migration are multifaceted. Heightened geopolitical conflicts in various regions have created an environment of unpredictability, disrupting supply chains and energy markets. Simultaneously, erratic trade policy announcements from major economic blocs have undermined the stability of global commerce, forcing corporations and investors to reevaluate cross-border exposures. Compounding these issues are questions surrounding the future policy direction of the United States Federal Reserve, which have introduced an additional layer of uncertainty into global financial markets. In this context, Switzerland's reputation for political neutrality and economic predictability becomes an invaluable asset. The country's stable governance, strong rule of law, and a well-capitalized banking system provide a stark contrast to the volatility seen elsewhere. Consequently, capital flows into Swiss assets, driving up demand for the franc as a primary vehicle for preserving wealth. This phenomenon is a classic illustration of how, in times of systemic stress, capital prioritizes safety over returns, reinforcing the franc's status as a preeminent safe haven. The appreciation of the Swiss franc, while a testament to Switzerland's economic strength, presents a formidable challenge for the Swiss National Bank, or SNB. The country is currently grappling with significant deflationary pressures, with the inflation rate hovering at a mere 0.1%. This is occurring even as the central bank's key policy interest rate remains at 0%. This situation creates a severe policy dilemma. Strong franc, which naturally results from safe haven inflows, exerts further downward pressure on domestic prices by making imports cheaper. For an export-oriented economy like Switzerland, a persistently appreciating currency also erodes the competitiveness of its goods and services on the global market, squeezing the profit margins of its multinational corporations and smaller exporters alike. The SNB is thus caught in a difficult position. On one hand, the institution is mandated to ensure price stability, which in the current context means combating deflation. On the other hand, the very factors that make Switzerland attractive to global capital are fueling a currency appreciation that exacerbates these deflationary tendencies. The central bank's traditional tools are constrained. Raising interest rates to normalize policy is untenable in a deflationary environment, while further easing could be seen as ineffective with rates already at zero. This intricate interplay between external safe haven demand and internal economic weakness forces the SNB into a delicate and complex balancing act, with very little room for error. The strength of the franc is simultaneously a sign of success and a source of significant domestic economic strain. The policy conundrum facing the Swiss National Bank is further complicated by the geopolitical landscape, which limits its available options for intervention. SNB President Martin Schlegel has publicly acknowledged the inherent risks, stating that any escalation of global geopolitical conflicts inevitably increases market instability, which is ultimately detrimental to both the franc and the broader Swiss economy. In response to the franc's relentless appreciation, the SNB may be forced to contemplate unconventional and politically sensitive measures. One potential, albeit controversial option, is a return to negative interest rates. This policy, previously employed by the SNB, is designed to make holding Swiss francs less attractive for foreign investors, thereby discouraging capital inflows and easing upward pressure on the currency. However, negative rates are unpopular domestically, as they penalize savers and can distort the functioning of the banking system. Another established tool is direct intervention in the foreign exchange market, where the SNB would sell francs and purchase foreign currencies to cap the franc's value. Yet this approach carries its own significant risks. Large-scale, sustained intervention could lead the United States administration, or other major trading partners, to accuse Switzerland of currency manipulation. Such an accusation could result in retaliatory tariffs or other punitive measures, creating a new set of economic and diplomatic problems for the Swiss government. The SNB must therefore navigate a narrow path, weighing the domestic economic necessity of a stable currency against the international political risks of its policy actions. Each potential move is fraught with trade-offs, making the central bank's task of managing the franc one of the most challenging in modern central banking. To illustrate how these dynamics might operate in practice, consider a plausible real-world scenario. Imagine a sudden and severe escalation of a geopolitical conflict leading to a sharp downturn in global equity markets and a spike in oil prices. In this environment, market participants would initiate a widespread flight to safety. Automated trading algorithms and institutional portfolio managers would simultaneously begin liquidating positions in higher-risk assets and reallocating capital into traditional havens. This would trigger a surge in demand for United States Treasury bonds, gold, and crucially, the Swiss franc. The EUR CHF and USD CHF exchange rates would fall sharply as capital floods into Switzerland. In response, the Swiss National Bank's governing board would likely convene an emergency policy meeting. Faced with a rapidly appreciating franc that threatens to push the domestic economy deeper into deflation and harm its export sector, the SNB would have to act. Its first line of defense might be verbal intervention, with public statements from the SNB president emphasizing the bank's willingness to intervene to ensure monetary stability. If the franc's rise continues unabated, the SNB would likely commence foreign exchange interventions, selling newly created francs to purchase euros and dollars. This would be a calculated risk, undertaken with the hope that the intervention would be viewed by international partners as a necessary stability measure rather than a competitive devaluation. If even this proves insufficient, the board would have to seriously debate a return to negative interest rates, a move that would signal its resolute commitment to preventing an uncontrolled appreciation of the franc, despite the domestic political and economic costs. This scenario highlights the reactive and high-stakes nature of the SNB's policy framework in a world defined by recurrent crises. Despite the significant policy challenges and the inherent complexities of managing a global safe haven currency, the consensus among many market analysts and institutional investors is that the Swiss franc is likely to maintain its strength throughout 2026. Several structural factors underpin this outlook. The ongoing rise in gold prices, another primary safe haven asset, often correlates with strength in the Swiss franc, as both are seen as hedges against inflation and geopolitical risk. More fundamentally, Switzerland's enduring status as a bastion of political and economic stability remains its most compelling attribute. In a world characterized by increasing fragmentation and policy volatility, the predictability offered by the Swiss system is a powerful magnet for global capital. Furthermore, Switzerland continues to run a substantial current account surplus, a reflection of its strong export performance and its position as a net creditor to the rest of the world. This surplus creates a persistent underlying demand for the franc, providing a structural tailwind for the currency. While the Swiss National Bank will undoubtedly continue its efforts to mitigate the negative consequences of a strong franc, the powerful global forces driving capital toward safety are expected to outweigh its policy interventions. As long as the global landscape remains fraught with uncertainty, the Swiss franc will likely continue to serve its systemic role as a premier store of value, attracting investors seeking refuge from the storm.